to the Monday Futures Market Outlook for August 22nd, 2011. This is Patrick Sresna. For those of you that have not had the opportunity to try out eminisource.com's trading room, a 5-day complimentary membership is available. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that we've gone through. Just the other week, we officially crossed below that 80-week moving average, and it begs the question as to whether now this is the beginning of a new bear market. If you go back to the 80s, there were a number of times when a drop below there lasted maybe anywhere from 3 to 6 months in duration, and then it returned back up. But obviously, in the last decade has also marked a very significant drops that have occurred over an 18-month to 2+ year time horizon. Nonetheless, we certainly do have now clearly a bearish signal. Just looking at the key intermarket observations, obviously the last 2 weeks have dynamically changed the landscape of the market, and we are below that 80-week moving average. And while that certainly is bearish in a much bigger picture, that doesn't necessarily mean that the immediate term over the next few weeks or months will be any extended selling. There's probably only marginal benefit to selling into this weakness, but probably any failed rally attempts are probably opportunities to deleverage your portfolios. The US dollar continues to be chopped within a range, forcing many commodities and bonds to move on their own, and you'll see that the bond markets have reached historically low yields at this stage and are ripe for a little bit of a breather as well. Commodities are oversold, so we'll see what impact that has on the overall marketplace over the next week or two. And even though that new longer term trends are now in place, all the markets have quite extreme moves and are ripe for retracement. So anywhere where we see some short-term market pauses, we'll be looking for market bounces. When we take a look at that S&P 500 on the daily charts, you can see that very big drop as it occurred in this cycle. That 1080 to 1100 on the downside has acted like a support, and now the 1120 over the last 2 days has created a short-term reversal, which is creating a positive open this morning. Really, at this stage, we are open to a number of different things. First of all, we had this wedge, and we were looking for that market at minimum to come back for a retest. Key bottom retests don't necessarily always have to hit the exact double bottom mark, and this is why we're going to watch this market carefully here, as if we get anywhere above the 1170 area on the upside, we have to be open to the idea that a retest is already complete. But nonetheless, if we did have any way today or tomorrow turn into a negative reversal where the markets immediately find themselves at 1120 or lower, that window would immediately open for a drop down to 1080 or even as low as the 1000 level on the downside. It'll be very important for the bulls to dig in these zones right in here and don't let these support lines give out. Overall, if we use the 2008 bear market as any indication after the first drop, there was even a 2-3 month period where the market kind of spent consolidating and working its way higher to a little bit higher levels, retesting previous overhead resistance levels before another major drop occurred. So if we see short-term bottoms come in these zones, we could probably over the next few months see retracements even back up to 1250, 1260 on the upside before another leg of a bear market could begin. Next year, I want to take a look at the US dollar index, and the US dollar continues to deteriorate down toward its support lines around the 73, 73.50 area. And if we had any breakdown of the US dollar index to new lows on the downside, it would certainly give the whole market a breather or a break. It will probably cause bonds to stall for a little bit, and it certainly would allow the commodities to retrace higher after being quite oversold. So we'll be watching what happens here. We'll see whether the support line holds. If the 73 level gives out on the downside on the dollar index, then we could see 72 and 71 very quickly on the downside. Now, in the much bigger picture, The one thing that would be the worst case scenario for the stock market and for commodities would be there being a short-term low on the dollar and a very robust rally begin. If suddenly we saw the US dollar work 75, 76 on the upside and then suddenly break out on the upside over a month or more and suddenly begin a new uptrend, that would very quickly cause the markets to spiral into a new wave of turmoil. So really, anyone here that's looking for a short-term low is really hoping for U.S. dollar deterioration here, because any rally would throw a wrench into any back tracing of the market. Next year, when we take a look at copper futures, copper continues to sort of consolidate along this 380, 390 support line down along there. It's quite possible that we even have copper return back to 410, 420 on the upside. But again, a lot of it will be a play on what happens with the U.S. dollar in the next cycle. But nonetheless, once copper finishes consolidating in this zone, we probably will see another attempt to break down. But we'll see what time frame that will occur on. More than likely, the next few weeks could end up being relatively stable for copper. Next year, I want to take a look at gold futures, and gold continues its parabolic rise, reminding me a lot of the way silver played out on the last stages of its rallies. That round number of 2,000 sits just $100 and some odd away on the upside. It is quite possible that gold finishes this with one blow off up to the 2,000 mark, creating a short-term high, and then just like silver has a very dramatic 2-3 day or even a 1 week market reversal, where we could even see $200 an ounce wiped out on the downside, and all that gold premium, the risk premium taken out of gold. And if you think about it, if gold off of those highs wiped out $200 plus, it would only bring it to the levels where it was trading at the beginning of August. So it's not like a $200 an ounce move here is taking it to unknown territory. Really, at some stage, gold will blow off and will correct here. So we would recommend that you only remain marginally invested in gold. Next, I want to take a look at crude oil, and crude oil has come down for a retest of that 78 to 80 zone on the downside. This is exactly what the stock market is doing for what we call a key bottom retest. At this stage, the stock market and oil probably will move very similarly, and if we we'll be watching crude oil up around this 85, 86 area, just as we're watching on the S&P that 1170 area. If crude oil rejects up here and the market rejects, both of them should roll over and still have another round of weakness. But if the stock market breaks above 1170 on the S&P, and at the same time we have crude oil break above that $86 area on the upside of crude, we could very quickly see both markets working their way higher over the span of a week or two. Finally, I want to take a look at that 30-year Treasury bond, and this is where a big risk really lays. That Jackson Hole conference is coming up pretty quick, and a lot of people are anticipating an intervention from the Fed, which is causing bonds to move up to these historical highs. Really, it's the last time there was when QE2 was announced, it marked actually a bond high at some stage, and so we're going to be watching here as these 30-year Treasury bonds are rallying up into that conference. Really, at this stage, really we see only limited upside on Treasuries, and it would be a reversal in Treasury bonds that would certainly take pressure off the stock market on the short term. So we'll be watching these markets very carefully. That was your Monday Futures Market Outlook. Thank you for joining me.